Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
All right, so we are live from Chicago. We are at the Marriott. If anybody's here in town for the Hedgeye Regional Conference, we are in the Marriott Lounge, the Club Lounge. I don't know what they call it, but basically it's on the second floor. If you can't get in, just tap on the door. We've got Bill Lester here next to me, and he will come let you in, let the party begin, let the education begin, let the Hedgeye Regional officially commence. So again, hopefully everybody can hear me okay. We got Lester who's just telling me stories, war stories, both market, options trading, et cetera, et cetera. It's been, so it's a good day. I was obviously paying attention, but certainly not that active today. Did not get a chance to catch the macro show, actually, so haven't been able to watch that yet. United's Wi-Fi was pretty garbage, but it was a pleasant experience, easy traveling. Even got leveraged CTA, the blue line, all the way from O'Hare into downtown Chicago. So pretty proud of myself for doing that, actually. but it probably shouldn't be. It's like just a very normal thing to do. But anyway, let's get right into it. We'll get into the notebook. Lots changed over the last in last week. The biggest thing which we called out last week was basically the energy complex and specifically oil, and how it was starting to diminish in terms of signal strength. And we now, a week later, have that as a bearish trend on the page, along with energy. Both made big lower highs, and oil itself, CL, WTI, made a big lower low this morning at 76.27. I believe it was down about 2%. Let me just check, 1 sec. Yeah, 2.64%, so down, closed at 75.33 today. So actually, those lower end of the risk ranges are dynamic, so that just moved lower. So expect that lower end of the risk range to likely, reflect that in the AM. So again, energy complex, we got in the Mucker family office, the long only account. We got out of pretty much all energy exposures, USO, XOP, small caps, even the natty gas equities exposures, FCG, even DBC. One of the largest components there is oil, and the silver related exposures as well. So the big shift yesterday in the MFO, which you can now see as the portfolio solutions product within Macro Pro, and you can get that on a weekly basis. So if you're getting that on a weekly basis, expect to see those changes in the week over week adjustments. Interestingly enough as well, we also sold out of all of platinum this morning in that product. So kind of really reducing a lot of the exposures. I think we've gone from, call it 28 to 30 in the long only account to a significantly less number. 1, 2, 4, 6, 8, 10, 12, 14, 16, 18, 20, 23 is kind of the number I got on my page. So, so again, we're making moves. We're adjusting the portfolio. We have been adding to precious metals. So I think that's a big shift. If you, not a big shift, but we were calling out the spike in volatility last week in GBZ, but that's come significantly down week over week by 290 basis points, down to 13.33 this morning, and trade up a little bit, but still definitely down in the kind of investable range. Last time Keith talked about GBZ, he was looking at sort of like a 13 to 18 risk range on that. That's very much what you want to see, and so keep an eye on that GBZ for gold and the gold commodities. OVX, on the other hand, is doing the opposite. So OVX is back up north of 40 again. So took a cup of coffee yesterday down at just south of 39. On a month-over-month basis, that's up 213 basis points. Yesterday, it was up 241 basis points, and today it was up 172 basis points. So that's like basically the complete opposite of what you're seeing in kind of the gold complex. and you saw gold itself push right down to kind of really close to the low end of the risk range today, which was 1952. It's closed down just below 1958. So that's a big reason why we were adding to the gold exposures, both physical and GLD. And in the breakdown there of some of that other precious, not all precious metals are created equal. Silver has turned to bearish trend on the page, so that's another kind of adjustment on a week-over-week basis. You did see a lower high and a big lower low in silver this morning. So just keep a track on that risk range. I think depending on your duration, oftentimes silver does trade in conjunction or with a correlation to gold. So it's just got a lot more beta and a lot more volatility on within that complex, right, within that piece of inventory. So it can be, if you are, kind of stepping outside of the gold range, there's a reason why we, treat silver as a commodity and gold as an FX, right? So a lot less volatility inside of gold. And that's really where we're kind of trying to, pivot the portfolio. If you look at what's in the top 10 inside of the Mucker family office, it's a lot of shorter term duration, gold, IVOL, UUP, that kind of thing, even in sort of in a way, a short kind of SPY, with a long exposure via BTAL. So again, that's kind of, that's kind of been the move. Keith has been talking for not the first time, but certainly it'd been a lot of quad 3 talk, right? A lot of quad 3 talk for the last few months, certainly a number of weeks, with the updated nowcast model that hit the pages or hit the deck on Monday. I was, Drago put it in our inboxes on early Sunday morning. So we went out another quarter. So that's kind of another new development here is our nowcast model now goes out to Q3 of 24. And the change, it shouldn't be really a surprise to anybody that's kind of paying attention, because even last week here in Notebook Review, we were talking about how the inflation piece was really right on the y-axis, right? So it was sort of, hovering right around, 3.5%. And given what we were, forecasting, nowcasting, it was looking like an acceleration in inflation, but although very nominal, with a deceleration in growth. Now, in Q1 of next year, we're seeing that inflation actually dip a bit, right? So it's actually now moving that to a quad 4 environment in Q1 of 24. So we still have quad 3 here in Q4 of 23 to wrap up the year. Quad 4 now on paper, currently being nowcasted in Q1 of 24, and then back to a quad 3 in Q2, and then I believe it's a quad 1, might be quad 2. Yeah, I believe it's quad 1. 1 second, sorry. I should know this. Quad 1. Quad 1 in Q3 of 24. But again, if you're looking at that inflationary piece, that's really the big driver of pushing that over to a quad 4 environment. So just keep an eye on kind of the inflationary data that's coming in. Obviously, with oil, going to bearish trend here, that actually really just exacerbates and continues to kind of highlight or solidify that potential quad 4 environment as oil is the number 2 component inside of the CPI piece. That CPI numbers, those numbers come out next week. So you'll get another inflationary print data point next week. So just kind of pay attention to that as well. I'm sure we will talk about it leading into it next week here on Notebook Review. The other thing too that just wanted to highlight, I think there has been a shift inside of the U.S. tech equity environment. We have gone from a lot of bearish trends on the page within the risk range product. Certainly last week in the prior couple weeks here that we've talked about on the Notebook Review. But now you're seeing a number of those kind of flip back. So you got Microsoft at bullish trend. Apple's trend level was 181, and it closed above that. I believe it was up around just north of 182 today. It's almost just south of 183. So that's actually a recaptured trend. Keith might keep that neutral just for another day or two, just to kind of confirm its trend signal move or move to bullish trend. But again, it's very, it's there on the page. If you're paying attention, you should certainly know now that Apple is bullish trend, and XLK has moved bullish trend. The two biggest components there would be Microsoft and Apple. So the underlying kind of tech environment is looking a little bit different. We had a big higher high in XLK this morning but you did see a lower low. So again, that just kind of tells you that you've got some increased volatility components inside of that risk range, which is making it widen. Amazon's bullish trend, Meta's back to bullish trend, Netflix is bullish trend, and Nvidia's bullish trend with a higher high there as well. So again, you're seeing a number of the Magnificent Seven, or I guess it's the Elite Eight is really what that is now. The Elite Eight, those you've got I guess 6 out of those 8 are bullish, with 2 that are bearish, which would be Google and Tesla. Tesla did have a higher low and a higher high this morning, so just keep an eye on what that looks like as we move forward over the course of the next kind of few days and over the course of next week, et cetera, et cetera. So again, I think you might see a component where, and you're seeing that within the tier 1 data as well, where breadth just is not there, and if you kind of take the extrapolation from the Russell 2000, Keith's been banging the table on this, both within RTAs and early look, et cetera, et cetera. But the Russell and IWM, a broader indices of stocks, looks nothing like the big tech, big cap, Elite 8, whatever, Sexy 7, whatever you want to call them, right? So those look a lot different than the rest of the kind of broader stock market. And the other thing too, also to call out, last week we did kind of mention that GDX had moved to neutral trend. That is now back to bearish trend. So GDX as an equity, and again, it makes sense when equities act differently than the commodity itself or the underlying component. So GDX is back to bearish trend, whereas ITA and defensive stocks are bullish. So those are kind of, you can find those in the out bucket within the risk range. And with that, I'll take a sip of water. Lester, do you have anything that's kind of coming up in your that's just been transpiring, or that you've been paying attention to over the course of the last couple of weeks that you're kind of trying to, again, just keep an eye on to pivot or mention?
The collapse in energy has to be number one on the list. I mean, we've got basically a recession going worldwide, and now energy is really starting to show that. And I too have been really shocked by the trading of gold. I would have thought that it just would have done better. As you pointed out a minute ago, miners have gone to bearish trend this week from neutral, which and I'm old, but I really just don't understand it. I would have thought gold would have got a bid this week. It's the thing that has most surprised me. But as you said in your opening remarks, all metals are trading bad, just simply trading bad. And that's the other thing we were talking about just before you opened up the weekly notebook review, is how bad it is getting fills and just spreads. The things that I'm noticing are the simple things, and that is that the market's just not trading well. Even on days where you get the machines working like they did yesterday and the day before, and you get some volume, but we're still not getting good trading action.
Yeah, no, that's a good point. And if you look at kind of like the volume section, or from the macro show, you're seeing the actual volume on a 1 year basis is back down to negative, minus 2%. This is as of this morning, yesterday's data. Excuse me. And it was minus 14% on a day-over-day basis. So even
last year's volume this time of year was anemic.
100%. Yeah.
You're going from anemic last year to just horrible right now.
Yeah.
And I'm really noticing it in spreads. If you just pull up something to make a trade on, the spreads you can drive a truck through, not a car.
Yeah. Yeah. Yep. No, it's that's a good point. Good call out. And I think I saw David out there. So I know last week we had some questions around tier 1. So both Craig and Michael couldn't make it for this evening session, but we'll get them on in the next couple weeks. And that way we can kind of have a bit more of a deeper dive on tier 1 and the options. But David, if you're around and you want to jump up, by all means, feel free. We can kind of maybe give some guys a background as to kind of sort of how tier 1 came about, and that kind of thing. But again, anybody that's out listening, by all means, happy to have you up to speak. This is Weekly Notebook Review is for Hedgeye Nation, just like these Hedgeye regionals and Hedgeye live events are. It's about getting together. It's about talking through, moves inside the portfolio, things that we're seeing on the page, et cetera, and trying to better position going into next week, next month, next quarter. Year end is around the corner here, so we got crazy enough. My mom was texting me about Christmas lists and Christmas shopping for her grandkids this week. So it's kind of nuts. But yeah, David, welcome, buddy.
Thank you, guys. Can you hear me?
You can, absolutely. Yeah.
All right. Well, thanks for having me. This is my Twitter Spaces debut, to be honest.
Brilliant.
Yeah, I eavesdrop on these sessions all the time, so it's not what this
It's lurking in the background. I love it.
That's right. Yeah, the kid in the back throws things at the kids in the front. Anyway, nice to meet everybody, and I obviously I apologize for Craig and Mike not attending today. They are definitely the brains of the operation. I'm just the bald fat guy that makes trades in the background. But Robert asked me just to give a quick background on myself and maybe tier one, so I'll give you the 30-second overview there. Obviously, I talked funny from South Africa originally, and then came to the States and actually got my citizenship through the U.S. military. And the funny thing is that being in the military actually taught me a whole lot about trading psychology in the end, in an ironic twist of fate. But Craig and I have been working together, 5-6 years. And my background is in majority currencies. And I manage it, small by some measures, significant by others, but I manage a decent currency and stock indices book. And then, Craig and I had started to develop tier one alongside Mike Green 2.5 years ago, and we've been very happy to partner with Hedgeye. And the currency side of it's very, very, very different to, obviously there's options involved on the currency side, but the whole systematic flows landscape is very different to what happens in the currency space. But like all things, we have to evolve, and knowing where the flows are going has been an interesting ride, and I think we're working on some interesting stuff that we can also talk about.
Yeah, David, just along those lines, so like what FX was kind of going to be the next thing that I was going to jump on. I got 2 question marks basically that I had written down in my notebook today, and plan on kind of discussing with Keith over here in Chicago over the next 48 hours. But both the euro and the British pound put in higher lows this morning. Now it could just be kind of FX vol's been has come down. Down as of this morning. It was trading around 7.65 is where it closed yesterday. So that's down 74 basis points in the last month, 46 in the last, on a week over week basis. So you're seeing kind of just volatility in general, all getting sort of suppressed. I mean, the move in the VIX in particular is kind of, I think I saw a tweet where it's the largest kind of point drop in this short of time since like 2015 or something. And we don't need to get into that right now, but just kind of curious in terms of what you're seeing from either flow standpoint or just generally what your how you're thinking through for me specifically the euro and the pound would be awesome.
Yeah. So there's a couple of things that we should definitely mention on the flow side, and particularly the VIX, and this will get esoteric very quickly, so we'll keep it simple. But the weekly options and shorter term options have basically taken the VIX and reduced its significance for now. And what I mean by that is, historically, the VIX calculation included 30-day options, which were the primary mechanism for hedging in the market. Well, now we've moved over towards hedging events in the market with shorter term options. And those transactions are not included in the VIX. So we're seeing the VIX fall out of favor quite quickly for shorter term options literally in the shorter term. And you got to remember that a lot of these shorter term options are getting hedged at the dealer level by the dealers themselves, basically hedging by buying and selling further out of the money options between themselves. And so we're seeing sort of this sporadic hedging between people with short-term options for events and then getting rid of them. And particularly this weekend, we didn't even see what we've been calling the war hedge, where, you know, people are buying puts into the weekend to try and hedge exposure, you know, geopolitically, etc. So the drop in VIX is largely because of the use of short-term options. Now, as far as what the dollar is doing, you know, I cannot be more bullish on the dollar, but we have also run into, particularly in the case of the pound, we've run into where the pound bottomed out right as Brexit happened, and that is not insignificant. Currencies are really, really technical in their movement, and what, you know, running into that Brexit support for the pound is not insignificant, but I think we will break, and that's the same for the euro. Yeah, we bounced a little bit today, but fully expect lower highs and to continue down. Those of us that are old enough to remember the 2008 crash, there was a lot of unwinding of the carry trade, and we can talk about that with the yen. But the dollar was by a mile the best thing to own, and I fully expect it to continue now. And that's what's so interesting about this market is, you know, tech might have gone bullish trend, but all the other markers of a bearish market are still there. You know, the Russell particularly, the dollar, the bond market, steepening, you name it, they're all marking the same thing except for one asset class. And, you know, we can talk about those dynamics a little bit, but nothing here is saying that we're not approaching or getting into deep in the bowels of the bear market yet, or closer to it.
Yeah, thank you for reminding me to mention the yield curve, because that was a massive move in a 6% like reinversion between the US 10s and 2s, and definitely need to be called out. So thank you for reminding me to do that, David. I saw that on the subway on the train into town, and I was like, okay, that's a big one. We got to talk about that. But yeah, no, you're spot on, man, and love having you up, because this is great color. You got a question, Bill?
David, are you seeing anything unusual? Are you seeing something that sticks out to you? I mentioned a few minutes ago that spreads are blowing out on my screen. You all have a much deeper feed of information. Is there something that is not necessarily troubling you, but making you go WTF?
I think it's, you know, I think from my perspective, it is, it's the, maybe complacency isn't the right word, but, you know, when we on the vol surface are pricing in 12s and 13s over the next couple of weeks, and we know that the macro picture continues to deteriorate, that is deeply concerning to me, because that tells me that we particularly underhedged, and the market will have to chase it if this starts to unwind a little bit, which is kind of what I'm expecting. Mike wrote a piece on Monday, I don't know if anybody saw it, about the market skew and how we're actually turning into a more negative skew in the options market, which has typically been a very bearish market over a trending duration more than just on the short term. So I think for me, it's more like Robert was saying, that the front end of the curve is, or rather the front end of the vol surface is just so complacent at the moment. And if we start to get any kind of enduring realized volatility bumps, that will force a ton of systematic selling that now has reaccrued and chased this market higher. I'm not sure what your thoughts are on that.
Yeah, no, I completely agree. I mean, I shared your economic event calendar with short-dated options positioning earlier today, and I just think it's absolutely brilliant in terms of just what it provides and the details, right? From and to your point, I mean, like going into, you know, jobless claims later this week on Friday, you're looking at you know, IV of on SPX of 12.19, And then you go out next week into CPI on the 14th, and you're just getting just under 14. Now again, that may shift, post today's events, but I highly doubt it, considering that we're seeing, we saw 14.44, I think it was, is where it closed on the VIX today. So we got, right down to Keith's low end of the risk range, which was 14.45. So, with that environment, it'd be, one might think that, the CPI number next week might go down to, 13.5 to 13, which is just crazy, to your point, in terms of just the shorter dated. And I think that's a massive thing, and something that I've certainly picked up on since just paying a lot closer attention to the tier 1 data, which I've always, greatly appreciated. But as you guys have kind of continued to build out some of these, like this event calendar, just makes it very, very plain sight to me, and just very easy to digest in terms of, okay, this is what's on the horizon from an economic data standpoint. This is what we can kind of potentially expect from a move in regards to, depending on what that, what the print is, what might we see from a plus minus standpoint. So that's been really great.
One of the things that I always like to watch is, and this is just how I interpret a lot of the systematic buying and selling, is I also like to watch the NIME index. That's the active managers index, just to see where they're positioning. And what's interesting to me a lot of times is, if we've seen big buying in the vol control markets or CTA funds, but we haven't necessarily seen volatility fall, that tells me generally that the market is likely to propel higher as volatility continues to fall after there's already been buying. And it works the other way around. This may sound a little convoluted explaining it without drawing it out, but if there's been selling in vol control space, or there's been selling in systematic strategies, and volatility has not risen in conjunction with those, remember that these are, a lot of times a product of realized volatility on a look-back basis. And then I expect the market to continue. So I think that Keith looks at those things the same kind of way. And at the moment, we're seeing a lot of systematic buying, and the market's being chased higher and volatility is low. So, those guys, with any measure of higher vol, the market is likely to sell off, but then also get chased lower exponentially, if that makes sense. I hope I explained that accurately. It's sort of what is the relative impact on volatility after buying or selling has happened, or preempting it? That's always interesting to me as far as the follow through and related trend.
Yeah, exactly. And I think you guys highlighted that in your note this morning. I mean, if you just look at where that, again, I'm going off the numbers from this morning, right on the GEX flip line, but it's going to change. We're going to get obviously new numbers come this evening and tomorrow morning. But if you just go off where we closed today on the SPX to where it is, or where it was coming into the open, you got to basically need about a 1% move lower, to your point, David, in order to kind of like go back and flirt with that, right? We're in positive gamma environment at the moment. And I think that's something that we talked about last week on here, David, which is, the sort of the difference, or again, like the very simplistic way of thinking about positive and negative gamma is that in a positive gamma environment, volatility basically starts to shrink, because dealers, buy weakness and they sell into any strength. But conversely, on a negative gamma environment, so if we get, like to your point, if we get, a 1.5% move lower, well, as soon as we hit that gamma level, that gamma flip line, we go back to negative territory. All of a sudden, the dealers are going to have to basically they're no longer supporting the market. What they'll do is they'll actually exacerbate it, right?
It's 100% right.
They'll move it negatively. And so that's the thing that I think everybody, when we're kind of right around this level, you got to be, even if you're a longer term investor, you got to be conscientious and aware of the flows and how those dynamics can impact the moves, right? So I think that's a huge piece.
Yeah, no, I mean, you hit it bang on there. That's absolutely the situation. And we think about the gamma flip line a little bit as a range, because obviously the weekly gamma flip line is going to be different to what the longer dated gamma flip line is going to be. So, candidly, there's still ongoing research as to how much dealers are actually transacting in the futures market to delta hedge with weekly options. We don't think it's actually very much. So we like to think of that gamma flip line as a little bit of a range, and we'll be expanding on that. But no, 100% to your point.
Yeah, awesome. All right. Well, anybody in the crowd, if you got any questions for TR1, I mean, or David in particular, happy to jump up. This session's probably going to be a little bit of a tighter one, just like letting everybody know just where we're here in Chicago, and going to get just want to kind of meet everybody that's in person. I know a lot of folks are flying in. Yeah. So yeah, go.
Yeah, just for everybody's knowledge, I'm the way we break up a letter every day is that Craig actually writes our before the market stuff that we send off to Keith and Hedgeye, and then I write the bonus content at the end in the banned section. So if there's anything on an intraday trading basis that is screwy, I'm the one to blame for that in the newsletter, and then Mike writes the opening piece regard to vol and gamma, etc. So that's how that's broken up, just to put a face to the content.
Yeah, that's awesome. No, appreciate it. Yeah, I always was curious, like who did what actually.
Hey, David, this is Bill again. I got a really simple question that I would like to ask. We, as basically U.S.-based traders, see a lot of volume in our country. Are you seeing volume discrepancies, as in lesser volume and in widening spreads in other markets that we should be aware of?
Candidly, Bill, I don't know. To be 100% honest with you, I would have to get back to you on that. I don't want to mislead you with poor information on that, but it's a good question, and I'd have to get back to you on that.
Yeah, totally cool. I know how to get in touch with Bill.
Yeah,
I know how to get in touch with you.
Yeah, no, I'd happily research that and get back to you. I honestly, I'm not sure. To your point,
There's a mark.
Sorry.
Hey, David, along the same line, is there a market that you look at specifically other than the United States when you're looking at volume numbers for just kind of a down and dirty observation method?
Yeah, I'll watch the DAX as much as anything else, if not a little bit of the FTSE, but predominantly the DAX. I wake up to, and that's more of a product of my human behavior. I wake up to trade the FX market typically, 2-3 in the morning Eastern time. So I find myself watching the European markets more, and the DAX is definitely that market for me. As far as behavior, is that leading the US markets? Is it telling me anything? And more in terms of behavior rather than volume on my end. We've seen
David,
that the European markets have basically levitated for the last year, and that became a very, very popular CTA trade, was pouring into Europe. But I think that's unwinding as well. I don't know how you guys feel about it.
Yeah, no, I mean, from a risk range standpoint, we're seeing lower lows and lower highs in the DAX this morning, and that's been pretty consistent. I think that the European data is flowing in regards to and really confirming the recessionary environment. I will say that the one component that I thought was interesting from the nowcast model update is you are seeing the Eurozone sort of picking up a little bit of quad 1, quad 2 potential from the nowcast. Now, again, just currently on the page in earlier than the US. So the US is in Q3 of 24. The Eurozone really come Q, really like starting 24, Q1, Q2, Q3. Even here in Q4, we're actually now casting a quad 1, quad 2, then quad 1, right? So Germany is going from a quad 1 in Q4, at least potentially on paper, to quad 3, and then back to back quad 1. So the Eurozone, it's interesting you mentioned that in terms of like CTAs and how they're unwinding it. And it'll be I think it's just an interesting, like right now the signal and the data is confirming recession in quad 4 environments, and basically stay away and or short, and that's certainly how we're positioning, David. But just from, again, like the signal trumps the quads, but just from a quad standpoint and what the data could look like as we go into 2024, I think it's possible. Again, it's very early days, but it's possible that our tune on euro might shift, in the coming months. So again, like I talked about earlier about, we're positioning for next week, next month, next quarter. I think the Eurozone right now, if you kind of put on more of the capital allocation hat, like a David Salem type longer term horizon hat, the Euro to me is like more of like a human capital deployment kind of situation where the signal and the pricing still looks like shit. But you've got maybe some GDP, maybe some more favorable conditions as you move into 2024.
Yeah, just philosophically, have we ever seen a year that has been more divorced from the macro environment than 2023? I mean, it's really amazing. It's one thing for us to tell we follow the math and we follow the flows, but from a psychology standpoint, it is a tug every day trying to set us, you look at European data, particularly German data, French data, and it's lamentable at best. And then, one's forced to participate a lot of times in the car driving uphill without the brakes, otherwise you get fired. It's a very strange thing. And has there ever been a year that has been more divorced from the macro fundamentals than this year? I haven't seen it in my career. But, at the end of the day, if people are employed, they are contributing to their 401ks, and those 401ks are buying at any price. And, that's the bottom line with all of this. And I know for ourselves, we concentrate a lot on where employment is going, where employment is going to be. And that's why we harp on that stuff so much, because at the end of the day, target dates, I think it was JP Morgan that ran analysis that something like 95% of all transactions in the market now are non-fundamentally based systematic transactions. And those are almost all principally, target dates, systematic flows, what is happening, and that is all based on employment. It's a wild time to be alive, really.
Yeah, I think you hit the nail on the head. Lester and I over here just shaking our heads, being like, "Oh, tell me about it." I mean, you're seeing it right now on the page, right? I mean, given the growth outlook for the U.S. in particular, and really just globally. You're seeing XLK move back to bullish trend, and things like Microsoft and Apple, Apple regaining bullish trend. You've got the NASDAQ composite at a neutral trend level right now, but putting in a higher low and a big higher high this morning. So given, I think just naturally, just given what price actions does, if it stays up here, it's very possible that it recaptures bullish trend, David. And again, that's something that, to your point, it's just a, I think at this stage in the game, we realize that the flows and the price action and the signal really does trump any of the economic data, and therefore it's the lead horse, right? Or it's reality's gone to the side. Yeah, reality is what Billy said. Yeah, reality's gone to the side, right? And so, but we still, at the end of the day, our jobs are to be as right as often as we can, and to be on the right side of things as often as we can. And so, yeah, I mean, I think it's just really bad I know Keith is, been a massive advocate of the tier 1 data and the fact that it's like an incredible new tool in his toolbox. And I don't want to, I'm not trying to pump your tires here, David. And again, I don't think we need Craig or Mike perfectly.
No,
it's a beautiful fresh breath of fresh air to have a South African on the line. First of all, it makes us sound much more intelligent, and it's much more
deeply misled, Robert. I guarantee you that I am definitely not the brains of the house.
Oh yeah, like Lester and I are the brains over here as well, David. So I think we just got a good trio going. But I mean, I think you're spot on, man. I mean, it's just about kind of taking taking the swings that you see, right, and then just being, having the tools in the toolbox and the tier one data in particular. I mean, it helped me navigate last week. I mean, I see Billy Z on the line here, who's a great internal Hedgeye partner, Andrew Friedman's associate, and he was asking me about the VIX, right, and asked me about kind of should we get long the VIX here? I'm like, listen, Billy, I mean, you've got basically event risk, and this is like stuff that I get from you, David, and from the deck from Craig in the morning, right? You're seeing the event risk, you're seeing that macro data, that macro event thing that I mentioned, that I shared earlier today via Twitter, and you can just, so many people are using these shorter dated options to hedge their risk. They're not putting on the 30-day kind of like basically like vol premium anymore, and they're using the 1, 2, 5 day outlook. I'm generalizing, but the basically the very short term outlook, and therefore the vol compression that was potentially going to happen was very much kind of like, to me, I don't want to say predictable, but it was just sort of like you'd seen the movie before, right? And so it was just sort of something that you could quasi anticipate going back down to the low end of the risk range. And now, did I see us going below 15? No, not even, like 14 spot 4, like going back to your commentary a few minutes ago about seeing 12s in regards to the SPXI, IV, and there's some of the hedges that we're just, from, I mean, that's just wild. It's wild.
The short dated stuff, the mentality has completely become, why own when you can rent, and in terms of hedges, and that's exactly what's happening. I mean, you said it way better than I could, and it's caused just a ton of vol compression. People are well hedged into CPI, well hedged into FOMC. Things don't necessarily materialize as bad as they expect, as life is. Everybody unwinds and chases the vol lower. It's a weird cycle we're in, but that is our new reality.
Yeah, you and again in the deck this morning, you included that CTA, like CTA buying and stuff like that. And I think it is interesting. I secretly kind of like love that chart, because I think CTAs have, where volume is, kind of generally kind of lower, right? The CTA volume can influence price action, and so to see that they, you guys called it out in your note this morning, but to see them kind of back on the board, they're kind of back into like what I would call more neutral territory. I don't know how you would classify kind of the they're just above zero, right? So just slightly back into positive positioning on U.S. equities, but that's been from a massively suppressed level of like minus 40 last week, I think it was, which we hadn't really seen since sort of early 2022 to 2019 and back to 2016 levels, which again I just thought was really interesting, and something where to me it's just mass, like these flows are just, if you're not paying attention to them, you're not seeing, like the decisions that you're making are uninformed, and that's like the least spot that you want to be in, right? So like you're flying blind. So again, I can't tell you enough again, and I think the tier one alpha stuff, as you know, David, it can be kind of a bit more shorter term, but again, like you're leveraging the intermediate term and the short term data in order to make longer term trend level decisions, so that you can ride things and have things in the portfolio on a longer duration. And that's where like your tools are just invaluable in my own opinion.
That's a very, very generous compliment and remark. Thank you, Robert. For obviously, Craig is definitely comes from more of the investor side of things, and David's more of a trader. And I know that's a 4-letter word for some reason these days, but I like to try and manage things a little bit closer to how Keith does, where basically you have a core position for the market cycle, and then you gross up and manage the core position around the cycle. That to me makes the most sense for me psychologically, and from a money making standpoint. And like you're saying, a lot of times we'll see that the vol control guys and CTAs, for instance, have sold all that they were going to sell necessarily, and that doesn't. That can only mean that the S&P or Nasdaq might only be down 3 or 4%, yet they've fully deleveraged, and then you're going to see momentum as they come back into the market, and that is irrespective of where the bigger indices are at. And sometimes that can be a little bit confounding. You might have seen the systematic flows fully deleveraged, but the market hasn't really dropped. And then the market can start rising, volatility, realize vol drops, and they start buying again. And that is irrelevant of where the index is. It's just going to push it higher, which, further disconnects us from where we are economically in the reality of things. It's very confounding, but one just has to kind of put that psychology to the side these days.
No, agreed. And they can be very challenging, right? But all right, so one kind of maybe like final question for you, David, and are you used or leveraging some of the data that we get or that you're providing from Tier 1 in sort of a manner that maybe, Bill and I and those listening in might not think about using it in that way, if that makes sense at all, in terms of other, I know you said you kind of like you trade, trade. Yeah. So just kind of curious.
I do. So I like to wait for things, particularly to line up, whether that's, 2 weeks, Friday, 2 weeks, time flies when you're getting old, but not the Friday before last, we saw Brett completely exhausted on a historical basis, meaning that we'd seen really lows that we hadn't seen since 2008 and then back in 2002. And the market had really not gone particularly far to we deleveraged nicely, but it wasn't, I said nicely, I'm a bear, so I'm a little bit prejudiced here, but I like to wait for those moments where we've seen Brett the exhausted and systematic flows have completely deleveraged themselves. And then if we see, a shorter term vol surface that lends itself to vol selling, maybe people have hedged for a event, or then that to me is a decent buying opportunity. So I like to look for the very extreme levels. And this goes for the selling as well. I like to look for situations where the systematic flows have increased their exposure to their historical maximum levels. Maybe breadth has greatly improved and the top of the range is below the gamma flip line. That to me is the perfect setup for shorting the things you like. And that doesn't necessarily mean shorting the Qs or shorting tech. They could be, trading the things you actually like and the things that have maintained bearish trend. And that to me is those times to gross up that exposure. So I like to look for the extremes and things. A little bit like Keith does with his risk range where, we'll have 14 to 1 upside or 14 to 1 downside. Those are the times to really copy DM. So, there's a lot of brownie in motion. And when you're watching it every day, one can get caught up in those moments, but they're very pointed moments in time where we've seen, full leverage on either top or downside, whether that's breadth or systematic flows, or, sort of big disconnects relative to market performance. Does that make any sense?
Yeah, 100%, David. I love that, and it makes perfect sense. And it's been interesting because I think it really speaks to what we've seen really since Friday, since we kind of recaptured positive gamma. Vol's crush, markets have been kind of basically sideways. Again, you can make moves and stuff like that, obviously, and position and things like energy have broken down, and so those portfolio risk management decisions still need to be made. But from just, if you're just kind of purely trading S&P or NASDAQ, what have you, it's been a little bit of a wash, I guess, right? So big time. But at the same time, though, we're also right up at the top end of the risk range, both like for on the tier one upper PV band. We basically opened there this morning, right, and pushed pretty close to the top end of the risk range on Keith's side as well, and at the moment, even to your lower band, it's down at 42.84 this morning, which again is I think that was like a 2.5, or I think that was about 2.5% downside if memory serves. Close. I was close. Two and a quarter. So that's a pretty good move to downside. So anyway, it's getting a little noisy here, the lounge, and I think Steve Smith, the retired Carolina Panthers wide receiver, just walked in, and I'm a big time. I grew up as a Panthers fan, so I'm gonna go say hi to that guy. I'm gonna fanboy out a little bit. But David, it's been an absolute pleasure to have you on the Notebook Review. Thank you for your commentary. It's been awesome. We're looking forward to having the whole team on in the future. It will be a lot of fun.
Yeah, thanks for having me on. And the next go around, I'll round up the Brains Trust, and we'll actually shed some real information.
Yeah, that's brilliant. Well, yeah, I might need to bring in some of my counterparts maybe, so that I can sound smart too and handle them. But anyway, it's awesome, David. Appreciate your time, and thanks everybody for tuning in and listening in. We anybody that's in Chicago for the regional event, looking forward to having some cocktails this evening and enjoying the education that is tomorrow. So appreciate it. We'll see you guys next week, 4:30 Eastern. We'll be back on the East Coast. And thanks for your time today.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.